Welcome back to Market on Close. It's time for Options Corner, so we'll say hello to Kevin Green. He's joining us now, our senior markets correspondent. Now, Kevin, we've had a bit of a choppy day. Started in the green. We're now kind of split and hanging around the unchanged line. What levels are you watching as we head into the close?
Yeah, I mean, Marley, you bring up a really good point. We did see, obviously, some strength starting off today, but we have had some weakness pretty much throughout. And actually, if we kind of look at what we highlighted earlier this morning, to the upside, 64.60 was kind of the level we were focusing on. We got to around that 64.52, 64.53-ish area. Also coincides with the 200-period moving average on the 15-minute chart. And pretty much to the T, we saw a rejection. Now, we're still above the 6,400 level. I think that's actually a win. And if you actually look at the premiums on the 0 DTE options for the SPX that are expiring today, a lot of the premiums on the wings have been, for the most part, withered away. So you're not really expecting a lot of action going into the close to the upside or downside. But if we're kind of looking at some key levels, 64.20, which is pretty much what we are holding at right now, and does also kind of coincide with a key area of support that we've been really trying to battle over the last, let's say, hour or so. We are trying to break up a little bit higher. We have been in a little bit of a channel if we're looking at that volume chart here. But to the upside, we have that next level of 64.50. I'm not sure if we're going to get there. There isn't any bids on the contracts. If you're looking at the calls for right now, that could change. So usually that kind of tells us that we probably are going to be trading in within a range around that 64.35-ish area is kind of what I have my eyes on kind of going into the close. So it was a decent day when you're looking at the advance in the S&P 500. Unfortunately, just losing that momentum, and if we continue to lose that momentum to the downside, doesn't really make you feel good. And we also want to be able to hold the 20-day moving average for the S&P 500 as well. I want to make sure that we call this out. That is sitting at 64.28 for the S&P 500. The reason why this is key, we have not broken below the 20-day moving average for the S&P 500 and closed below it for more than 2 days. Pretty much since actually the April lows. So this is kind of it's a small thing, but it's a big technical item that you want to be able to try to recapture very quickly instead of having that 20-period moving average on the daily act as an area of resistance, which once again go up, test, and potentially fail, which is not good for the bulls.
We saw the catalyst this morning with the Alphabet ruling and thought it might be enough to hold up the markets. It didn't prove to be. Did we see an increase in volume or an uptick in volume because of that, or was it just a normal trading day?
Well, so the volume is definitely lopsided when you're looking at the Mag 7 names, Apple and Google. Obviously, we've seen a significant amount of volume that has been traded on today's session just so far. But if you're looking at the broad S&P 500 composite and you're looking at the difference between the up volume versus down volume, we really kind of mix. It hasn't been that big of a day. And so does that mean that we have enthusiasm in this market? Really not that much, but we're also not seeing the market completely getting knocked down too aggressively here. This is one of those days where luckily 2 or 3 stocks were able to kind of hold us up, at least for now. And what we're actually hoping for is that over the next couple of days, that market will actually broaden out. Now, I think the biggest risk that we have over the next couple of days, one of the bigger risks is going to be the ISM services data print tomorrow. That could come out a little bit bearish, and that's where you could see some pressure stepping into the market, especially when you're looking at the communication services sector as well as the technology sector. And if we are seeing prices paid actually come in better than expected, then the broadening aspect kind of gets a little bit easier. You have consumer staples participating, consumer discretionary participating, even industrials, and that also probably would be bullish for the equity markets because of the rate cut expectations that we have moving forward here. So regardless of what the intraday action kind of shows, it hasn't been too lopsided one way or another when you're looking at volume for the S&P composite.
And I was, taking a look at yields. Yesterday we saw the 10-year jump on news that we could potentially have to pay back some of this tariff money. But now we're seeing them swing lower today, retesting these lows after we got our JOLTS report today. Have you looked at any of that at all?
Yeah, I think the 10-year is going to be, it's going to be rocking a hard place right now, and I think it's going to see either a breakdown or a breakout here fairly soon. We have been coiling up for a very long time. We have this kind of triangle formation taking place where, for the most part, 4.18% on the 10-year future has been an area of support, and we continue to see that downtrend or that resistance line that's in white. And the reason why I think this is actually very pivotal, we're sitting at around that 4.2% level. Marley, we haven't really broken below or stayed below 4.2% 4.2% for more than one day, pretty much since May of this year. Actually, even going back, you're looking at around April, late April, mid-March. Mid-March, late April here. And so I think that's actually a very big deal. Do we start seeing some buyers stepping in on the longer end of the curve, the 10, 20s, and 30s here, and starting to catch up to the shorter duration? I think that's going to be something that not only the equity market's going to really fuel itself on, but also the commodity market. So we haven't, it seems a little bit heavier here, or having more buyers kind of step in on the 10-year this time around than what we've seen in the past, where we've had really quick re-ratings back higher when it comes to rates, which has been, for the most part, actually somewhat of a headwind in some respects for equities. And now the market really is just kind of focusing on the 2-year and trading off of that. But I think this one is a yield that we definitely have to look out for here in the coming weeks.